Welcome to The Explainer. Today, we're breaking down the pretty complex world of stock options. We're going to cut right through all the jargon and build a clear, simple framework so you can understand exactly how they work, whether you're a trader playing the market or an employee trying to figure out a job offer.
Okay, so here's our game plan. We're going to tackle this systematically, consultant style. First, we'll nail down the core idea. Then we'll dissect an option into its key parts. After that, we'll look at how traders use them and then pivot to how they work as employee compensation. And finally, we'll walk through how you actually turn an option into stock and, of course, how to handle the taxes. It's a really logical flow from the what to the so what.
All right, let's start with the single most important idea. Before we get into all the details, we got to answer the most basic question. What really is a stock option when you boil it all down?
Okay, burn this phrase into your memory. The right, but not the obligation. This is everything. This isn't like some other contracts where you're locked in and have to buy or sell. Nope, an option is all about choice. You're paying for flexibility. You get the power to make a move if things go your way, but you can just walk away if they don't. That one little detail is what makes options so powerful.
So this basically splits the entire options world into two camps. It's pretty straightforward. If you think a stock is going to go up, if you're optimistic, you want a call option. That gives you the right to buy it later at a price that you hope is a bargain. But if you think the stock is going to go down, you're looking at puts. That gives you the right to sell it later at what you hope is an inflated price. Simple, right? Calls for up, puts for down.
Okay, so now let's pop the hood and see what these things are actually made of. Whether it's a call or a put, every single option is built from the exact same set of key components. Think of these as the specs that define what an option is and what it can do.
These 5 things right here, they're like the DNA of any option. Each one answers a really critical question. The strike price tells you at what price you can buy or sell. The expiration date tells you by when. The contract size is how many shares we're talking about. The premium is what it costs you. And the style tells you how flexible you are. Let's look at each one.
The strike price. You can think of this as your line in the sand. If you've got a call option, you need the stock to climb above this price to make money. If you have a put option, you need it to drop below this price. Everything, and I mean everything, hinges on this number.
In the world of options, the clock is always ticking. That expiration date is your hard deadline. Your bet has to pay off by that day, or the option becomes worthless. And then there's the style. American style is more flexible. You can cash in your option any day you want before it expires. European is stricter. You can only do it on that one single expiration day.
And this is where it gets really interesting. It's all about leverage. When you buy one option contract, you're not just controlling one share of a stock. No way. You're controlling a block of 100 shares. But the price you pay for that control, the premium, is just a tiny fraction of what it would cost to buy 100 shares outright. This is how you can get those massive gains. But, and this is important, it also means your risk is magnified too.
Okay, enough theory. Let's see how this stuff actually works in the wild. We're going to put all these pieces together and look at how a real trader might use options to make a bet on a stock.
So let's take a look at a real-world example involving the tech company NVIDIA. Let's say a trader is feeling really bullish. They're convinced the stock is going to rally past the $170 mark. Now, instead of spending a ton of money to buy the stock itself, they decide to use options to make their play.
So check out this number. This is what the trader actually puts on the table. To get control over 1,000 shares of NVIDIA, they don't pay the full market price, not even close. They just pay the premium, which in this case is $16.10 per share. That comes out to $16,100 total. And that's the absolute most they can lose if they're wrong. Okay, and this is super important to get. It's not enough for NVIDIA's stock to just squeak past that $170 strike price. Why? Because the trader has to make back the money they spent on the premium. So to actually turn a profit, the stock has to rise above the strike price plus the premium they paid. That puts the real break-even point at $186.10. Anything above that is pure profit.
All right, let's hit the brakes and switch gears completely. We've just seen how options are used for high-stakes trading, but they have this whole other life inside of companies as a way to pay and motivate employees. So what are ESOs? Well, you can basically think of them as a company giving its own employees call options on its stock. The whole idea is to get everyone pulling in the same direction. If you, as an employee, help the company do well and its stock price goes up, you get to share in that success by buying stock at an old, cheap price. It's a really powerful way to get and keep great people.
Now here's a key difference. You don't get these options all at once. You have to earn them over time. And that process is called vesting. A really common setup is a 4-year schedule, like this one. It means you gradually get the right to your options year by year. It's the company's way of encouraging you to stick around and help build long-term value.
And, companies can get pretty creative with how they structure these plans. They're not all the same. A fixed value plan is all about stability for the employee. A fixed number plan really doubles down on that pay-for-performance idea. And then you have the mega grant. That's the big one-time offer designed to lure a star executive with a potentially massive payday down the road.
All right, so imagine this. You've put in the time at the company, your options have vested, and even better, the stock price has soared way above your strike price. That's awesome. But how do you actually turn that valuable piece of paper into actual shares of stock? Well, that process is called exercising.
Now, you might be thinking, who has enough cash just lying around to buy thousands of shares of stock? And that's a great question. Most people don't. That's why these cashless methods are so popular. The exercise and sell is for when you just want the cash profit, right now. But the exercise and sell to cover is for people who believe in the company and want to hold on to the stock for the long term. It lets you get your shares without having to front a huge amount of cash.
And you know what comes with making money, right? Yep, taxes. This is the final and frankly critical piece of the whole puzzle. Cashing in on your options creates a taxable event, and the rules can be really different depending on exactly what kind of options you were granted.
So when it comes to taxes, the two big things to remember are when you pay and how much you pay. With what are called incentive stock options, or ISOs, you get a much better deal. The tax man usually waits until you actually sell the shares. But with non-statutory options, or NSOs, which are more common, you get hit with the tax bill the moment you exercise. That profit, the discount you got, is taxed as regular income, which can be a much higher rate. It's a huge difference.
And that quote really just nails it, doesn't it? At the end of the day, that's what this is all about. We've looked at two totally different worlds, high-speed trading and long-term employee incentives, but they're both powered by the exact same financial tool. And understanding the framework we just walked through is what gives you the power to use them smartly in either world.
So, there you have it. We started with this kind of confusing term, stock option, and now we have a solid, structured framework to understand it. The next time you see options mentioned in a company's earnings report, or, better yet, in your own job offer, you won't just see a number. You'll be able to break it down and understand exactly what it means. Thanks for joining this explainer.